Florida's condo fantasy isn't just slowing down as we head into 2026. It's coming apart at the seams. Across city after city, prices aren't easing gently or slipping by a few percentage points. They're plunging hard, down 25%, 30%, and in some cases even more compared to highs that felt rock solid only a couple of years ago. People who bought at the peak are now opening statements that show their equity has all but vanished. For many retirees, the promise of a steady, low-stress lifestyle has unraveled fast. Instead, they're dealing with skyrocketing insurance premiums, special assessments running into the thousands, or even tens of thousands, and monthly expenses that keep rising regardless of what the broader market does. At the same time, listings are piling up, for sale signs sit untouched for months, and demand keeps thinning out. HOA fees continue to climb as associations scramble to pay for deferred maintenance, comply with new safety regulations, and absorb brutal insurance hikes. In a growing number of buildings, it now costs more to simply own a unit than that same unit can realistically bring in as a rental. What was once marketed as the Florida condo dream has quietly become a financial endurance test, pushing everyday owners to see just how much strain they can absorb. This is Discover the Cities. If you're looking for clear-eyed cinematic deep dives into housing markets that are breaking down long before the headlines admit it, make sure you subscribe. Today, we're counting down 10 Florida cities where the condo market is facing serious trouble in 2026. Number 10. Sarasota. Along Florida's Gulf Coast, Sarasota was once held up as the model everyone else wanted to copy. Pristine white beaches, a refined arts and culture scene, and sleek glass condo towers lining the bay were all wrapped into a glossy promise of effortless value. For years, the pitch barely changed. Pay the premium now, because it will always be worth it later. That assumption has collapsed under some harsh math. Condos that were trading hands for roughly $600,000 in 2022 are now struggling to attract buyers anywhere close to $420,000 in 2026, a drop of about 30%. At the same time, the number of listings has surged, rising well over 50% from just a year ago. Some local estimates suggest inventory is now more than 60% higher than it was during the height of the boom. What really twists the knife is what's happening beneath the sale prices. Insurance bills that once sat around $3,000 per year are now landing closer to $9,000. Add in new statewide reserve rules and stricter structural safety requirements, and HOA dues have ballooned, with reserve contributions alone reaching into the four-figure range. In many buildings, owners are facing more than $1,200 every month in association fees before even touching a mortgage payment or property taxes. Then come the special assessments. It's not uncommon to see $20,000, $30,000, or even $50,000 per unit demanded to cover concrete restoration, roof replacements, or mandatory compliance upgrades. For retirees living on fixed incomes, there's no painless way to handle that kind of financial blow. Some take on debt, others sell for far less than they once expected, and some simply wait, hoping boards can postpone the inevitable. Investors are feeling the squeeze as well. Rental returns that once made sense at around 7% have slid toward 3% or lower, once higher insurance costs, swelling HOA fees, and increased vacancies are factored in. Even short-term rentals are underperforming, as an oversupply of units has dulled demand during what used to be peak seasons. Beyond the spreadsheets, the atmosphere has clearly changed. Agents who used to close multiple condo deals each month now sit through long stretches with few showings and even fewer offers. Developers quietly sweeten deals with incentives, discounts, and closing credits just to move units that were once expected to sell out before construction wrapped up. Local banks have grown cautious too, asking for larger down payments on older buildings, or refusing to lend at all when reserve funds look thin. Number 9. Bradenton. Just north of Sarasota, Bradenton long lived in the shadow of its flashier neighbor, and that worked in its favor. Prices were a bit lower, the spotlight wasn't as intense, and many of the same Gulf Coast perks were still on the table. For years, it looked like the sensible, more affordable way to buy into the coastal Florida lifestyle. By 2026, that value story is fraying. Condos that pushed close to $400,000 during the buying frenzy have slid to below $280,000, representing a decline of roughly 30%. At the same time, listings have stacked up fast. Recent snapshots show more than 1,500 condos sitting on the market, a dramatic jump compared with just a few years ago. The real trouble is that ownership costs have surged far beyond what the market can comfortably support. Monthly HOA fees that once hovered around $300 or $400 are now commonly landing between $500 and $900. Insurance, which used to cost about $2,800 per year, is now arriving closer to $7,000 or higher. Add those expenses to a mortgage rate near 7%, and many would-be buyers are staring down monthly housing costs well above $2,200. For a growing share of households, renting simply looks cheaper and less risky. Investors are usually the first to feel that shift, and Bradenton is no exception. Short-term rental returns have weakened as occupancy rates in once popular complexes drop into the low to mid 50% range and nightly rates soften. Buyers who locked into pre-construction deals at peak prices are now hesitating when it comes time to close. Some are even walking away from deposits rather than taking ownership of a unit that no longer produces positive cash flow. Bradenton's traditional stream of buyers relocating from colder states has also slowed. Retirees running the numbers are comparing Florida's all-in monthly cost to similar condos in the Carolinas, Tennessee, or inland metro areas, and realizing the sunshine premium doesn't stretch as far as it used to. The outcome is a kind of gridlock on listing sites. Flippers who expected fast resales are stuck covering HOA fees on vacant units, while developers who broke ground in 2021 and 2022 are juggling higher interest costs on construction loans alongside slower sales. Number 8. Daytona Beach. On Florida's Atlantic side, Daytona Beach built its identity around speedway fame, spring break crowds, and rows of oceanfront condos that promised a view without the luxury price tag. For years, it leaned hard into being the affordable beach option. Not South Florida pricing, not Gulf Coast buzz, just accessible, middle-class coastal living with a set of keys in hand. That pitch is under serious strain in 2026. During the height of the boom, condo prices in many Daytona buildings climbed into the low 200,000s as investors and second home buyers rushed in. Today, many of those same units are changing hands closer to $160,000 to $170,000, marking declines of roughly 20 to 30%. Inventory has surged, and in several complexes, identical floor plans are stacked against each other, all chasing the same limited group of buyers. The biggest surprise shows up in the monthly expenses. Insurance policies that once cost around $2,000 a year have doubled, or worse, in older waterfront towers. HOA fees that used to feel manageable now often land between $500 and $900 per month, as boards raise dues to build reserves and meet tougher inspection and safety requirements. On top of that, come special assessments for concrete restoration and structural repairs. For snowbirds and retirees living on fixed incomes, that combination can be brutal. Some owners trim spending everywhere else just to stay current, while others list their units for less than they paid simply to avoid the next wave of charges. Condo associations, meanwhile, are caught in the middle, chasing delinquent payments while trying to keep contractors and insurers satisfied. Investors aren't escaping the squeeze either. Daytona's short-term rental market is crowded, with condos competing directly against hotels and a growing number of similar units along the beach. Occupancy rates have slipped, nightly prices are under pressure, and long-term rents aren't climbing fast enough to offset higher insurance, HOA fees, and property taxes. A walk along the beachfront makes the shift hard to miss. Buildings that once turned over quietly now display clusters of for sale signs. Units sit for months, fall out of contract after inspections or financing issues, and then reappear on the market. Lenders are increasingly cautious with older properties that have thin reserves or unresolved reports, shrinking the buyer pool even further. Number 7. Orlando. Orlando, the heart of Florida's tourism economy, was long viewed as a safe bet for condo buyers. With world-famous theme parks, non-stop conventions, and a steadily growing metro population, demand seemed baked in. Condos were often pitched as reliable, income-focused investments backed by an endless stream of visitors. That confidence has taken a hit. During the pandemic-era surge, condo prices near downtown and along major resort corridors climbed toward $310,000. By 2026, Many of those same units are selling closer to $230,000, roughly 25% below their peak. At the same time, active listings have ballooned, nearly doubling as thousands of condos across the metro site unsold. On the cost side, the pattern is becoming all too familiar. HOA dues in many buildings now fall between $600 and $1,000 per month, while insurance premiums have roughly doubled since 2021. The result is a sharp jump in monthly carrying costs. A typical two-bedroom condo that once required about $1,800 a month to own can now demand more than $2,600 once you factor in the mortgage, property taxes, insurance, and association fees. Tourism hasn't been enough to fix the equation. The rush into short-term rentals around Orlando overshot actual demand. Complexes near International Drive and other tourist-heavy zones are packed with units listed across multiple platforms, all competing for a shrinking pool of travelers. In some buildings, occupancy struggles to reach 50% and nightly rates continue to soften. Add in Florida's newer structural inspection and reserve requirements, which are triggering special assessments of $10,000 to $20,000 per unit in older buildings. And lenders have grown cautious. Financing has become tougher for properties with thin reserves or unresolved inspection reports. Even buyers paying cash are pushing for deep discounts to compensate for the added risk. On the street level, the mood shift is obvious. Blocks that were covered in sold signs back in 2021 now show long stretches of listings that sit unchanged for months. Owners who once assumed they could always fall back on short-term rentals are learning that the numbers don't automatically work anymore. Orlando's condo market is a clear reminder that tourism is powerful, but it isn't magic. When ownership costs rise faster than both local incomes and rental returns, even the theme park capital has to answer to the math. Number 6. Cape Coral. During the pandemic years, Cape Coral's maze of canals became a visual shorthand for the Florida dream. Waterfront condos with private docks and glowing sunset views felt like can't-miss investments, the kind buyers assumed would only grow more valuable with time. That confidence has eroded fast. By 2026, the numbers tell a much harsher story. Median condo prices that once reached roughly $340,000 have fallen toward $240,000, a drop of about 30%. At the same time, inventory has surged, nearly doubling as new listings hit the market far faster than buyers are willing to absorb them. Insurance costs sit at the center of Cape Coral's unraveling. Premiums that averaged around $3,500 back in 2020 have ballooned to $10,000 or more for many waterfront units. Monthly HOA fees in the $600 to $900 range are now common, and special assessments tied to flood mitigation, roof replacements, and structural work frequently land between $20,000 and $30,000 per unit. For retirees who paid cash, the ongoing costs now rival, or even exceed, what a mortgage payment would look like. Investors who once banked on vacation rentals are feeling the pressure too. In some complexes, occupancy has slipped below 45%, with total monthly income coming in well under early projections. The lingering impact of Hurricane Ian, along with revised flood maps, has made buyers far more cautious. Condos in higher-risk zones or aging buildings often attract little interest, even after significant price cuts. To make matters worse, several private insurers have pulled back from the region altogether, pushing owners toward expensive state-backed coverage. The shift is impossible to miss. Canals that once saw listings disappear in days are now lined with balconies and boat docks staring out at rows of for sale signs. Developers who rushed to build during the boom are left juggling partially completed projects and buyers trying to renegotiate their deals. Number 5. Jacksonville. On Florida's northeast coast, Jacksonville built a reputation as the stable, no-drama option. With its sprawling footprint, expanding metro area, diversified job base, and a cost of living well below South Florida, it attracted both local buyers and out-of-state investors looking for a safer way to play Florida real estate. By 2026, that sense of security is being challenged. Median condo prices that once hovered around $230,000 at the peak have slid closer to $180,000, marking a drop of more than 20%. At the same time, listing inventory has surged, with roughly 60% more condos on the market than during the boom years. Once again, the numbers don't line up. Monthly HOA fees averaging about $400, combined with insurance premiums near $4,000 a year and higher mortgage rates, are pushing typical ownership costs toward $1,700 per month. Comparable units, meanwhile, are renting for closer to $1,400. For many buyers and renters alike, that gap makes the decision simple. Out-of-state investors from higher-cost markets played a major role in driving prices up during the surge. Now, many of those same owners are looking for the exit. In recent market snapshots, more than one-third of active condo listings in key neighborhoods show documented price reductions. Downtown and riverfront developments that were supposed to fuel a new wave of urban revival are now leaning on concessions and incentives just to keep units filled. What's especially painful is how quickly the tone has changed. For years, Jacksonville sold itself as a steady, upward-moving market. Residents trusted that its mix of military installations, logistics hubs, and a broad employment base would shield condos from the kind of swings seen elsewhere in Florida. Higher interest rates, insurance shocks, and tighter lending standards on older buildings have proven that assumption wrong. Today's buyers are walking into sales offices with a very different checklist. They're asking about reserve funds, inspection records, and insurance exposure before they ever ask about floor plans or views. Jacksonville remains a major Florida city with real strengths, but the belief that it was immune to the condo downturn has quietly fallen apart. Number 4. West Palm Beach. For a time, West Palm Beach proudly leaned into the nickname the New Miami. Sleek high-rises, luxury branding, and a wave of incoming wealth pushed condo prices to heights that would have sounded unrealistic just 10 years earlier. By 2026, however, the ceiling on that luxury narrative is becoming hard to ignore. Median condo values that peaked above $400,000 in 2022 have slipped closer to $300,000, representing a decline of roughly 25%. In several higher-end buildings, individual units have fallen even further from their original peak listing prices. The drop in value alone would be painful, but it's the surge in ownership costs that has truly changed the equation. Insurance premiums in some coastal towers have tripled, climbing to $12,000 per year or more. HOA fees in prominent buildings have doubled as well, landing near $1,000 a month. On top of that, unexpected special assessments of $30,000 to $40,000 per unit are no longer outliers. As condo boards rush to meet new state requirements and address years of deferred maintenance, the financial strain keeps intensifying. Short-term rental math is also breaking down. Occupancy in many luxury buildings has slipped below 50%, while nightly rates have softened at the same time. Lenders, meanwhile, are increasingly cautious, hesitating to finance units in towers with maintenance backlogs, weak reserve funds, or heavy concentrations of investor-owned units. The visual shift around the city is hard to miss. Towers that once glowed with near-full occupancy now reveal long stretches of dark balconies after sunset. Agents quietly acknowledge that affluent buyers are submitting offers 20% below asking and seeing them accepted. International capital that once flowed freely into Palm Beach County is becoming far more selective, favoring newer developments with stronger engineering and insurance profiles, or bypassing the region altogether in favor of other states. Number 3. Tampa. When you look across the bay at Tampa's skyline, the cranes, rising towers, and sweeping waterfront views are still there. For a long time, that image represented nonstop momentum and a city on an unstoppable upward track. By 2026, though, the picture tells a far more layered story. Median condo prices have fallen from roughly $310,000 at the peak to around $230,000, a decline of about 25%. In premium areas like Bayshore and other sought-after corridors, units that once sold close to $600,000 are now struggling to fetch $400,000. Overall inventory has ballooned as well, with thousands of condos actively listed, the highest count Tampa has seen since the last major downturn. Ownership costs have risen sharply. Monthly HOA fees in many towers have jumped from around $450 to as much as $1,000. Insurance costs near the bay have roughly tripled, with some properties now facing premiums approaching $9,500 per year. For buyers using conventional financing, it's no stretch to see total monthly expenses climb past $2,400, a serious burden in a metro where median household income sits near $70,000. The fallback option of short-term rentals isn't offering much relief either. In many Tampa buildings, Airbnb occupancy rates are running below 50%, and nightly prices have been cut to stay competitive. In some neighborhoods, nearly 40% of active condo listings already show recorded price reductions. At this stage, psychology matters as much as supply and demand. During the pandemic surge, Tampa attracted remote workers and transplants escaping higher tax states, fueling a narrative of permanent growth. That confidence has worn thin. Construction schedules are stretching out, and new developments are being delayed as builders rework budgets around higher insurance costs, pricier financing, and slower pre-sales. Flood zone reclassifications, stricter inspection requirements, and tighter lending standards are all adding to buyer uncertainty. Many are now asking whether they're stepping into a stable, long-term asset or something that keeps shifting under their feet. Tampa still benefits from jobs and population growth, but its condo market can no longer ignore a basic reality. Prices and costs eventually have to align with what local incomes can realistically support. Number 2. Aventura. Just north of Miami, Aventura built its reputation around a simple promise: upscale condo living without the chaos. Waterfront views, polished shopping districts, gated security, and a steady flow of international and out-of-state buyers gave the city an image of stability. Even when other Florida markets stumbled, Aventura was seen as a place that stayed calm. By 2026, that sense of certainty has faded. Condo prices that peaked near $600,000 in 2022 have slid toward $440,000, a decline of roughly 27%. At the same time, listing inventory has ballooned by about 80%, with both aging waterfront towers and newer mid-rise buildings carrying units that linger on the market for months. Rising costs are driving much of the unease. Insurance premiums across coastal Broward County and northern Miami-Dade have roughly tripled since 2020, often climbing past $12,000 per year for buildings near the water. HOA fees in many luxury developments now exceed $1,200 a month. New reserve requirements are also triggering additional special assessments, commonly ranging from $25,000 to $60,000 per unit, especially in older towers built decades ago. Buyers from New York, Latin America, and Europe who once treated Aventura condos as financial safe havens are now doing the math more carefully. When total ownership costs exceed what a unit can reasonably generate in rental income, the idea of safety quickly turns into concern. Short-term investors who relied on seasonal rentals are feeling the pressure as well. Softer demand, tighter local regulations, and heavier competition have pushed occupancy below 50% in some buildings, even as nightly rates slide. Developers who previously sold South Florida as a stability play are quietly adjusting tactics. Closing credits, buy-down incentives, and temporary HOA coverage are increasingly common tools to move remaining inventory. Agents on the ground say negotiations are slower, buyers are more cautious, and the expectation of automatic appreciation has disappeared. Aventura remains affluent, visually striking, and filled with residents who genuinely enjoy living there. But 2026 has delivered a clear message. Even in luxury enclaves, soaring insurance costs, hefty assessments, and weakening returns can undermine the foundation. Number 1. Pensacola. Topping the list is Pensacola, a city long marketed as the more attainable version of the Florida dream. With Gulf views, a strong military presence, and a laid-back small city feel, it was pitched as a safer and more affordable coastal option compared with Florida's larger, flashier metros. Over the past few years, though, that sense of security has proven far more fragile than advertised. Condo prices that peaked around $310,000 in 2022 have slid toward $215,000 by 2026, a drop of roughly 31%. Inventory has surged as well, jumping close to 90% year-over-year in some segments. Buyers now have plenty of choices, while sellers are discovering they've lost most of their negotiating power. At the same time, the cost of ownership has climbed fast. HOA fees that once hovered near $400 a month now frequently approach $800. Insurance premiums for waterfront properties have tripled in many cases, pushing past $7,000 annually. With mortgage rates near 7%, total monthly expenses can easily exceed $2,200 in a city where median household income is around $60,000. That gap is hard to ignore. Investors who once viewed Pensacola as a reliable cash flow market are feeling the strain. Short-term rental occupancy has dropped below 50% in many complexes, nightly rates are down, and long-term rents simply aren't rising fast enough to offset higher insurance, taxes, and HOA fees. Properties that once looked dependable on paper are now losing money month after month. New statewide reserve requirements have added another layer of pressure. Older buildings that postponed maintenance are now facing special assessments ranging from $20,000 to $40,000 per unit to fund structural repairs and rebuild reserves. Some owners can cover the cost, others list at a loss, and a few walk away entirely, leaving associations scrambling to collect unpaid balances and lenders quietly blacklisting entire complexes. Pensacola's downturn stings because it was sold as the middle ground. Not as speculative as Miami, not as dependent on tourism as some Gulf Coast towns, just a stable, livable place by the water. In 2026, that narrative is much harder to defend. The sun still comes up over the bay, but beneath the calm surface, the condo market is under serious stress, and the people who trusted its stability are absorbing the fallout. Florida's condo market isn't simply going through a mild correction, it's facing a reckoning. From Sarasota and Bradenton on the Gulf Coast to inland hubs like Orlando, from Cape Coral and Jacksonville to West Palm Beach, Tampa, Aventura, and Pensacola, the same pattern keeps repeating. Insurance costs surge. Aging buildings confront stricter safety rules and costly repairs. HOA fees and special assessments rise just as borrowing costs increase and investors pull back. This isn't a typical cycle where prices dip and then rebound. It's a structural reset, one where the real cost of owning a condo in Florida is being recalculated in real time. If you're considering buying into this market, old slogans and glossy photos won't protect you. You need to dig into reserve funds, insurance histories, inspection reports, local wage levels, and long-term climate risk. You have to ask whether the people who live and work in these cities can still afford to own the units that fill the towers.